passing on your wealth through succession planning. And then we've touched on this earlier. So the next slide, I think I've mentioned earlier, and I think still have you, Naomi, that life insurance is a popular choice to offset inheritance tax liabilities. So like I said earlier, if you're transferring the property, making a gift to a beneficiary, a child, a friend, a sibling, then you want to think of insuring that against that gift. Or even if you own property or own a portfolio of properties, right now, whether the property is owned in your name or in a company or in a trust, the revenue, the tax rules now in the UK since the last 4 or 5 years mean that the revenue can look through all of those structures and tax directly your ownership of this asset, whether you're a shareholder of a company that owns the property. It's all irrelevant now. So I do work with clients, and we look at, especially if they have more than one property or even one significant property, what's the IHT exposure, because it's 40% over and above the first 225,000. So you own a property worth £1 million, for example. I'm in the UK. The first £325,000 is tax-free, inheritance tax-free. The balance of 625 times 40% is taxed, and so you've already got about a tax bill of £200,000, and you're thinking this is the property you bought and which you want your family to inherit, and not just protecting the mortgage, which you might have done already through mortgage protection, but then you then have this inheritance tax bill to pay. So Naomi is going to show us the next slide just a couple of quick sort of calculations, depending on male, female, age range. It does depend on the state of your health, for example, but at least you can see how low the premiums can be, or how high.
Yeah, exactly. Thanks, Bimpe. So yeah, we've found that whole of life insurance is becoming more popular, and it is a really good way of covering that IHT liability. So with the whole of life policy, you know that as long as you pay the premiums, that policy is going to pay you that money. As long as every month you pay the premiums, it has no end date on it, and the policy will pay. The benefit of the premiums with this type of insurance is they are fixed and guaranteed premiums, and they're not linked to any investment. So no one's going to get any nasty shocks when you get older with these premiums, which was a big problem with the investment-linked whole-of-life plans in the UK. So I spent a lot of time reviewing people's insurance where it had gone from £400 to £800 as they've gone for a 10-year reviewable period. These policies won't do that. This is the premium you will pay, and it is the only premium that they will quote. So for example, on the first one, you've got two people here, a couple, 40 years old, £500,000 worth of insurance, and that is going to pay on second death because it's going to be written into a trust for your children, because spouse to spouse, there's no inheritance tax liability in the UK. The liability is when if it's a husband and wife, you both die, and then that liability sits with your children. So in that instance, this insurance policy would be written on what's called a joint life second death basis, written into a trust for the children, which would mean that it would pay a tax-free lump sum. So that 500,000 is paid tax-free, no tax to pay, directly into the trust for your children then to pay the inheritance tax liability, if that's what it is. I think mostly I would say with whole of life insurance, think about it as an investment, because you know that that's going to come back to you. It's going to come back to you 100%. You pay those premiums forever, that policy is definitely going to pay. And if you think about it in that way, you take that £379 a month, times it up by 12, times it up by, if you went to 50 years, the money that you get back, usually when we look at the rates, is double what you've paid in, approximately, dependent on, obviously, how long people live for. But, if you both live to 90, then you can times it up, and you can look at that and go, actually, yeah, I'll have paid in this, but I know that I'm going to get this back. It's going to be paid back tax-free. And also another way of thinking about whole of life is by taking it out of if you're taking it out of your UK company, it's money that you would pay inheritance tax on if something happened to you. So you're taking it out of the business, you're paying your whole of life premiums on it. So you're removing that and the need for tax. And then it's going into this, I would say, if you view it as an investment, then this life insurance will pay your children, and it will pay them £500,000. There, I wanted to also say it's important to tackle these things as soon as possible. Like it is, you know, people, it's always a difficult conversation to talk about life insurance. People find it hard. It isn't an easy conversation, but I find that the longer we leave insurance, the more expensive it gets. So as we get older, the premiums go up because they're based on our age. And also the premiums, as Bimpe touched on earlier, are based on our health. So if you're taking out insurance and you're younger and you're healthy, your premiums are going to be a lot cheaper than if you wait 10, 15, 20 years and come down the line and then want to take it out. So by showing you that, so on the second set of quotes, you can see joint life based on being 50 years old for 500,000. So you can see that the premiums have gone up by about 200 a month. So the cost of delay is that will cost you extra in the monthly premiums, but they are again fixed and guaranteed. And again, if you times it up and look to age 90, 95, the premiums you put in will be much less than what you get out in the benefit, I guess, which is ultimately it, whole of life.
Absolutely. Well, thank you. I mean, you're right. This is one premium, if you do a whole of life, that will pay out, because I guess as they say, there are two things that we can be sure of: one, death, and the other is taxes. So, you know, whilst death might be certain, at least we can use this to mitigate or actually stave off the sort of tax burden that death often brings with it.